Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and we are doing the options guide. This is cracking the code to trading options. All right, so without further ado, let's get on with this. I'm going to be somebody who starts out with simple concepts, builds to real-life examples, and by the end of all of this, I think you'll have a solid understanding of what we're talking about in the options world. All right, so at the end, we'll talk about real strategies, and I think you'll even be able to be answering my questions before they even come out of my mouth, if you will. Let me share my screen here. Like I said, this is the options guide to trading options. And we are going to do this video on the long risk reversal, folks. And let me explain real quickly what the risk reversal is. The risk reversal is generally used for a long position, and you create a synthetic short position around it if there are times like these corrections that we're currently having, so you can minimize some of your downside risk with a risk reversal. This is the long risk reversal. So this could minimize downside risk in accordance to what we would talk about with, I don't know why I lost my screen there for a second, but risk reversal right now, if you had a bearish position, you could put this risk reversal on a bounce. Now, another way that we can use this as a bullish trade. The brilliant part about this strategy is it acts like the underlying. Remember, we did the synthetic long, synthetic shorts before. Well, this is very similar to that. But if you remember when we did the synthetic longs, we did that where we built it out to be 100 deltas. So it would work just like the underlying. All right. And this one is going to act like about a 50 lot. Rather than having on a 100 lot, we're going to be working with a 50 lot. So the original concept with this strategy was to reverse the risk in your position or in your portfolio. If you were majority long, then you could use the bearish or the short risk reversal to hedge that position, or with the long risk reversal, you would be hedging a negative or a bearish strategy, okay? But not having the underlying in our portfolio, we can use this as a limited, or it's not limited risk, I should say, but less risk than we would incur if we had the outright, or if we went out there and just bought like maybe a 50 lot of the stock, okay? But before we get to all of that, let's slow this down. Let's make this simple. You know, when we're talking about data transfer, it's kind of similar to going over and looking at the option montage. There is all kinds of numbers changing, and it can be very intimidating. I'm not going to lie. But what we're going to try to do is make this simple. We're going to pause this, freeze frame it, strip it down, peel back the onion, whatever analogy you want to use, but really slow down what we're looking at and take it piece by piece, really is what I want to do. And when we're transferring data using O's and ones or zeros and ones, that's the most simple way to transfer data. It's streamlined, it's fast, but there are several layers to it. So when we're talking about options and in the option montage, all of the numbers in there are going to be changing, but I'm going to show you why and how you can really understand the levers and pulleys going on. All right. So to start over to real life examples, simple concepts, if you will, who's really been out there like looking at houses lately? As a matter of fact, I just heard the median home price is up to $391,000, another friggin' record, guys. Now, are we going to stay that high? Well, with higher interest rates, we would expect these prices to come off a little bit. But right now, recently, we've just seen prices in the housing market just skyrocket higher. And the reason why is because we've had some inflation. There's some money. We're coming out of this pandemic. There is folks looking to buy, and they're willing to pay through the nose. It's more of an urban sprawl, if you will. Like, I live in Arizona, and folks are moving here from California. They're driving housing prices higher because they're leaving a state that housing prices are astronomically high, driving up the curve. And here in Arizona, they're a little bit more reasonable. So they come here and think that they're super cheap and are buying it. And folks here are just like selling with both hands, it seems like. But what I'm talking about is housing prices have gone up almost parabolic recently. But if you roll back to, from 2000 to now, 2022, we've absolutely seen housing prices ebb and flow. As a matter of fact, even during the pandemic, before we saw the real spike here's the COVID. If I were to draw it in, maybe we had 2008 here, 2008, 2009. So we have seen prices move high and low, and they aren't always constant. So when folks are telling you, what's the best investment advice you have, a lot of people will say, buy a house. It's the best investment you can ever make. Well, that's if you bought low and sold high, which you really don't ever know if you are buying low and selling high when you're buying a house, do you? It really just kind of feels like you're always buying high and maybe selling higher, but it's difficult to put a value on objects like a house or like this pen. For one person, it might be worth nothing. Another person, it might be worth $100. So when we're talking about buying low and selling high, while it's a novel idea, when we're looking at charts, obviously this would be the place to buy, right? Because that's the low area, but we don't often get that entry level. We start to see the market move and we get on board with it, right? Well, so for instance, we could think when we're shooting up here, it feels like it's high, but we decide to buy. And we buy thinking we're buying low. Of course, how many times have you bought something and immediately went in your face, right? But market may rebound. You could sell up here, but you're probably thinking you're a genius here with a light bulb. That's supposed to be a light bulb. Light bulb moment. Thinking you're a genius, but then it corrects. What if you sold here? Well, did you sell high? Maybe not, especially if it bounces. But if it drops there, then yeah, maybe you did. If you didn't sell there and you sold here, you might have thought you were selling high because you expected it to go down, but it rebounds, So when we're looking at buying stocks, especially right now in my daily market commentaries that I do during the week, you guys have heard me talk about this for months now, is the fact that going forward right now, we were pricing stocks based on an economy that was going to be doing pretty good. And if we saw the economy show some kinks in the armor or shuddering a little bit, well, I said the thing that's going to be a problem with the stocks is forward multiples. When we're pricing a stock, it's based on multiples, like X times their earnings over the course of the future. All right. So while expectations were through the roof for a while there probably aren't so much right now. So those multiples are coming off. So maybe it was a 15 or a 20 multiple. It might be now a 10 multiple, right? Well, if it's a 10 multiple, just there brings down the price. All right. So we can see that happening in the markets. And that's why we're seeing these incremental drops. So while it's a novel idea with stocks to buy low and sell high, it's not always that easy because the price of a stock is very difficult to discern whether it's a good value or a bad value. Even if you're an expert, even if you've been trading for 30, 40 years like myself, all right, it's still difficult because of that multiple on the stock, all right, on their earnings. They take their earnings and multiply it by 15 or 20, all right? But options on the flip side of that will tell us whether or not their pricing is cheap or expensive because we have a chart we can reflect to determine this. Now, when you think about it real quickly, options pricing is driven by several different things. The movement of the underlying, the amount of time, and volatility, all right? Now, the amount of movement up and down, the ebbs and flows, is delta. And when we're looking at all of these things in the option montage, now I'm not trying to run you away. I'm getting a little ahead of myself right now. Think about everything in the options montage, the deltas, the gammas, the theta, the vega, rho, all of that stuff are assuming advancements, meaning moving higher or moving forward, all right? Not going backwards, but moving forward is the first thing you got to remember. All of them are moving forward, whether it's higher in time or something like that. So it's always moving forward. But options, like I said, give you a clue as to whether they're cheap or expensive based on volatility. And more specifically, what we want to look for is implied volatility. All right? Implied volatility. Now, implied volatility is forward-looking. A lot of you folks may have heard of historical volatility, and I'll talk about that towards the end here. But implied volatility is the expectation of future volatility. So it's forward-looking. That's why I like to look at it a little bit more. It's also got a little fancy name. It's called Vega. So if you've seen it over there in the option montage, Vega is implied volatility. When you get over there, they're just being cheeky or whatever you want to say by making it a quote-unquote Greek. Funny, Vega isn't even a Greek, to be quite honest. So, you know, delta, gamma, theta, those are all Greeks. Vega is a Greek, quote unquote. All right. So it's just implied volatility. So when you're hearing implied volatility, just start knowing, hey, we're talking about Vega. All right. Implied volatility is just Vega. But what I want you to notice about implied volatility, while stocks, you know, sometimes have bullish markets, and you see those ebbs and flows like this, right? And we got a bullish market going, or bearish markets, right? You see the ebbs and flows going on. Now, with volatility, the thing is each underlying, each specific underlying, whether it's ABC, Tesla, Apple, PDQ, whatever it is, every underlying, every stock has its own implied volatility coefficient, if you will. Like it will stay within a range, all right? It will break out of that range every once in a while, but we see that it'll break out and really revert back to the mean. So implied volatility looks like this. And the beauty, a lot of you chartists out there will be able to draw nice little support and resistance lines around that volatility because, for one, it's a little bit easier to see ranges sideways for most people. It takes more of a trained eye, generally speaking, to see bullish, bearish trends and trend channels there. But on a sideways one, we can often, our eyes line up nicely with a horizontal, if you will, type of trading pattern. So we can pick when price is expensive. How? When volatility percent is up here. All right. So when Vega or volatility, let's just say implied volatility, starts rising, then we know that the premiums over in the option montage are rising as well. All right. Per percentage point. Remember I said at the beginning, everything's on the advancement. So this is 1 percentage point increase expected. All right. So if we get a 1 percentage point increase, all of the options, whether it's expiring in a day, a month, or a year, all of those options are going to fluctuate based on what implied volatility is doing. All right. So if implied volatility or Vega says it's 10 cents, every 1 percentage point increase, that option is increasing by 10 cents all across the board. All of them are increasing. If it goes down, then they all decrease. But what that means is if we know that there's a pretty finite range, right, with Vega, and I'm going to show you several real life examples in a minute, we can see that once volatility is at these levels, we know that it is super expensive, right? We know we got money in those premiums. And then when volatility drops down here, we know there's, you know, pennies and cents. I'll do cents down there. All right. They are pretty cheap, at least in regards to the last, you know, year or 6 months, depending on how you look at it. So this is another snapshot of a real life example of implied volatility. And it doesn't matter, like I said, if it's ABC, all right? So if we're looking at ABC's implied volatility range, I like to have a couple of them. I like to try and hit as many tops as I can usually. So I'd try to draw a line kind of like that, if you will, and try and encompass it as much as I can. Couple of tops hitting, breaking through. I'm not too bad with that. All right. So when we're looking at implied volatility, we know that this underlying has a pretty decent range. Excuse me. And as this goes down, what happens to the premiums over there? We don't even care what month it is. Every single month that has an option over there in ABC is going down every percentage point. All right. Every time it down takes a percentage point, we would see those premiums get cheaper. So when they get down here, this is a buy zone. And I like to say, trying to draw a line about 50-50 there. And then the sell zone is in the upper band. All right. So if you're up here, volatility, it's a sell. If you're down here, it's a buy. All right. Meaning you're buying, you're doing a debit spread on the buys and the credit spread on the sells. All right. And I'll show you this in detail here in a moment. So let's just go back to this one. Doesn't have a very good marking on the time here. So it's right there around 35. But we can see, again, we've got our range. We could say that we would draw the line kind of in between here. It's pretty close to about 50-50 in my eyes. I'm thinking it's probably right around there somewhere. It's probably right around in here is the 50-50. Somewhere right around in here. So, and if you are newer to trading options, you could draw two more lines in there, break it out into quarters, right? So if you're newer to trading, this would be your sell zone in that upper band, and this wait for more of the extremes, okay? Or if you have a lower risk tolerant trading regimen, all right? So sell zone in that upper band. If you've been trading a lot, you have a higher risk tolerant, you trade crude oil or something like that, well, then maybe you're going to have a wider band on that. All right, so here's another one. We can see once we draw out this one, right, we're taking this particular one, like for folks that thought maybe I was kind of funky on my lines, well, we draw this out quite a bit, and you can see that it's pretty much in line. You know, yeah, after COVID, it got a little bit higher, but we've been experiencing higher volatility across the board everywhere the last couple of years since COVID. Not completely bizarre there. But what we can see, though, is that these lows, we're coming into the lows pre-pandemic, so pretty in line with its historical average, right? So when I'm saying right now, hey, it looks like it's cheap or expensive, well, in relation to the last 3 years, it's still holding pretty true. Again, here we can stretch out to pre-pandemic. You can see this stock. It doesn't matter. What I'm trying to convey here with these several ones and not telling you what the underlying is it doesn't matter what this underlying is, if it's ABC, Tesla, or IBM. What we're trying to determine here by looking at the implied volatility chart is whether or not premiums are expensive or cheap. And we can see that this is on the rise, so we think that they're getting more expensive, right? Once it gets up to those lines, that's where I would be looking to add credit spreads. When it gets down here, these are your debit spreads, all right? This is your debit spread, all right? You want to do the debit. So if I haven't beat this dead horse enough in your head and you come up with nothing from this video other than volatility, implied volatility is what really drives pricing, I think I've done my job. And some of you folks might be saying, hey, no, dude, if I'm looking at pricing over in the option montage, I look out 300 days. Those premiums are a lot more expensive than the ones that are like 8 days away, they expire. Well, yes, because the longer duration options, you have to buy more time to be right. So when you're paying up in the further durations, the reason why is because you're giving yourself more time to work this strategy out into your favor. So you have to pay for that time in a sense. But volatility at any given time, it doesn't matter what the underlying is doing. If the underlying didn't move a penny, time didn't pass, and we saw volatility uptick, all of the premiums are moving higher in that particular underlying's options, all right? If it downticks, all of them are getting cheaper by that amount, okay? So let's get to this Apple trade, or I didn't do this one here, but we can see that it is right on the line in this case. It doesn't matter if I'm trying to pick a bullish move here, which I probably would be. If I was picking a bullish move here, I would probably, because it's right there in the middle, want to try to isolate volatility a little bit. Or if I thought the volatility was going to continue to come out, I would be doing my credit spread, right? Because you want to sell high and buy low. And if volatility is going down, you know those premiums are going to get a lot cheaper, all right? And then before we get into the other stuff, I want to do something real quick. I'm going to give you guys a few hacks that will help you guys remember some of these scary Greek names, all right? So one of them, the first one, let's start out with the one that most people are most familiar with, and that's delta, all right? And delta is the rate of change, if you will, all right? So when we're looking at the at-the-money options, those are the ones like if we're talking about XYZ, let's just say, is trading $100 on the open market. So that would mean that the options that are the 100 contract, put and call, are at the money, all right? If it is a call below, then those are in the money. And if it's above, that's out of the money. And flip side for the puts. But if we're looking at the calls, let's say I've got 100 strike here on the calls. That would probably be right around a 50 delta, all right? And that means that if XYZ moves higher by $1, right? That's what we talked about. $1 move higher, then this option, these calls would go higher by 50 cents, all right? So let's just say those $100 calls were $2.50. Well, if it moved higher by $1, they would increase by 50 cents and go to $3. All right. They would be then $3 after that first dollar move. Okay. So that's delta. And most people will talk about it as just that. Now, one thing I like to look at is when you're looking at the option montage, those are the at the monies, you got those 50 deltas. And then if you go further out of the money, you start looking at, like, say, the 110 calls, right? Now, those might be like a 35 delta, all right? Now, delta tells us that if the underlying moves higher by the dollar, our premiums would increase by this 35 cents. But on the floor, one of the things we would look at delta, we didn't even care about how it was affecting our premiums, because literally delta is one of the least worrisome Greeks at any given time when you're trading. You're not really worried about delta. You're seeing the market move up and down. You know that is affecting you. But probabilities, what a lot of people will see is delta is the probability of being 1 penny in the money at expiration, meaning once the life of this option has gone through its course, last day, last moment, delta tells you that on that last moment in time, you got a 35% chance of being 1 penny in the money. That's what a 35 delta would tell you. You got a 35% chance of being 1 penny in the money at expiration. But on the floor, what we would say is 2 times the delta equals your probability of touch. All right. Now, the reason why we'd say it's a probability of touch is because during the life of the underlying, it's moving up and down all the time, right? Delta is the probability of it landing 1 penny in the money at expiration. 2 times the probability is your probability of touch during the life of this option. All right. So if it's a 70 days to expiration, that 35 delta, it says during this next 70 days, you have 2 times the delta of it trading your price. So a 35 delta, that 110 call, has a 70% probability of trading 110. Just one time. I mean, it's just got to trade one time. You see it print, boom. All right. That is your probability. It could continue higher. It can go deeper, but the probability of touch is 2 times the delta. Delta is your probability of being in the money, right? So much better probabilities of touch than actually finishing in the money. So a couple of things with this number is it will really help you keep your powder dry. It'll help you when you're thinking about probabilities of your success. All right. If you have a 35 delta and the underlying hits that 35 delta, well, you've beaten the probabilities. All right. You could look at it that way. If you were long that call, you beat the probabilities, cover it. Don't wait. You had a 70% probability of seeing that trade happen and only a 35% chance of it being in the money. I think I'll take my better odds. All right. So that is delta. Then we have gamma. Gamma is simple. Gamma, it just goes with delta. So gamma goes with delta, easy. Sometimes these at the monies will be like 10 cents or something, okay? So delta is dollar number one. Gamma is the second dollar higher, okay? So this is on dollar number two. So when we saw these premiums, 50 cents go in on the first one, right? We saw 50 cents go in there. Now that after the first dollar, they're trading 3. Now gamma goes with delta it should be going with that delta, 50. So now we have 60 cents, right? We've got 10 cents. Gamma goes with delta, then it goes back into this. So then after the second dollar, it would be 360. Does that make sense? Throw it over there in the questions box, folks. If you have any questions, please. I'm not going to wait to the end to answer your questions. If you guys have questions, I will answer them during this. So gamma goes with delta. First dollar move, we went from 101 to 100 to 101. That increased our premiums to $3. Then on gamma goes with delta, 60 cents goes in there. And we got that to the second dollar. All right. So it'll incrementally get bigger and bigger on that call side. So gamma goes with delta. And then we've got the thief. Some of you guys probably thought I was spelling theta wrong. Theta is the thief in the night that comes and steals theta. Theta is the thief in the night that comes and steals your premium. All right. So it is always negative, a question mark, whatever the premium is, because you can't go back in time. Remember at the beginning, I said it's always an advancement. We're always moving forward. Well, in time, we always are moving forward. So unless you have a time machine, you can't go back. And options assume you don't have that. So every day that goes by, this thief comes and steals money from you. That can be a good thing. It can be a bad thing, right? If I'm doing a debit spread or anything like that, I don't want theta to be stealing from me. But if I sold something, sell high, sure, I want that help, right? You want those premiums to drop as fast as they can so you can get out of this trade. So the thief is not consistent, or he is consistently increasing. It's not binary. It's not linear is what I guess I'm getting at. It kind of starts out a little bit slow and then picks up steam and then drops off. So we can look at it like this is 7 days to expiration. And then when it starts picking up, I'm going to say this is probably where it really starts to pick up. Days to expiration. 35 days is the sweet spot. 45 days is kind of where I will go out to as far as I go out on the buys. Because I think that this is the buy zone, right? If we think that we see theta really picking up, where do you want to be? Or if we see theta, I'm just putting my foot in my mouth right now. If we see theta, the thief in the night that comes and steal our premiums, nobody was correcting me there. 45 days is right here. 35 days right here. Thief is really picking up. What do you want to do? Buy high and sell low? No. So this is your sell zone. You want to sell somewhere inside of this area going there. That's your sell zone. 70 days to expiration here is where we're talking about. Days to expiration is our buy zone. You can go further out. I just like the 70 days to expiration is kind of the wheelhouse there for me. I usually am in a trade for a few, 2-3 weeks maybe. And so, you know, the premiums are not cheap, but they aren't as expensive as you get out, a couple 100 days out. So while I'm buying, I'm limiting the theta decay. You can never really completely eliminate him from that buy like that, but you can see that it is slower, and then hopefully I'll be out of the trade before it starts getting into this sell zone there, all right? Because that's where we really see that premiums start to pick up. So you don't have to worry about the Greeks, right? We can go over here to the option montage now, and it's easy. We can go to delta and see delta is just data. This is the call side, right? We've got our calls and we've got our puts. And these are the different expirations I was talking about. How long this life of this option is, okay? Meaning you have to pay for more time to be right. Well, those options are reflective of that, right? So delta, you can see those ones that are at the money on the calls and in the puts are very close to 50, right? Further out of the money, they get smaller. Further in the money, they get bigger, right? You can see the in the money ones are more, the further out of the money ones are less. That's, you can even think about it as, what are my probabilities of being in the money at expiration by 1 penny? Well, the ones that are in the money already are pretty good on probabilities, right? But delta affects the in the money, deeper in the money options more for one, but it will affect the rate of change of those options. And then, like I said, on the $2 move, gamma goes with delta across the board. Gamma would go to its respective delta on that $2. And then the theta, that thief in the night that comes and steals your premiums, look what happens. If you're out here outside of 70 or days to expiration, and you basically come in 90 days it takes for these premiums to double. And then basically you move in 20 days, the next 20 days, that inside that 35 days to expiration, remember that I was talking about, inside that wheelhouse of the sell zone, look at that, just less than 20 days, that theta has doubled, okay? So the closer you get, theta gets more aggressive. And usually if I was looking out here at 70 days to expiration and looking 30 days in, it probably would only have increased by a couple of pennies. I probably would have been around 7 cents or something like this at around 70 days to expiration, right? So look for that as well. This option did not have that luxury, so I had to opt to go a little bit. All right. One thing with this strategy, though, I do want to mention with the Vega and everything else, one thing with this strategy is we are creating a synthetic long position, if you will. It's not a 100 lot. Like when I'm talking about 100 deltas, remember that when you are buying at the stock, it's assumed you're buying 100 lot, all right? If I went out there and bought EA, it used to be you had to buy at least 100 contracts, okay? Anymore, it doesn't pan out that way. But the options are related to that theory or that whatever, what we're accustomed to. It was 100 lots, so options were made to be reflective of 100 contracts. So every one contract is equivalent to 100 of that underlying, all right? So when we're looking at delta increasing and Vega increasing, one of the things we can do, like I said, is we can offset it, right? If I buy a call and maybe sell a call somewhere else, I can offset some of those negative aspects, right? Because if I sell it, it does the opposite to this as the one that I bought. And it's very similar if we buy a call and sell a put, right? That put we sell can help offset some of those negative effects. So let's go into the option montage real quick and look at this. So we're looking at the further duration options. I want to give myself a little bit more time to be right. And also with this strategy, the beauty in it is we can pretty much offset all of those aspects we were talking about that are negative to this position or a buy or sell. The other thing is when we're doing this strategy, because we're offsetting theta, remember, because I'm buying a call and selling a put, those are offsetting. So the theta is offset, but I can go further out in time and don't have to worry about theta. I don't have to worry about Vega. Vega affects further duration options more as well because I bought one, sold one. Now, the more this market jukes back and forth, or especially if I start seeing the positive move I'm looking for, then some of those Vegas and the thetas will start getting a little bit out of whack. But meaning my theta on the one that is further out of the money is going to be less than the one that is nearer to at the money. So you could see, like, if I got that rally, you could see that the theta starts increasing the closer here goes, and the further out it would start going down a little bit there. So when I pick this strategy, I'm looking to buy at around the 25 delta, folks. And the reason why is because I've got a 25% chance of being in the money, which is pretty decent, but a 50% chance of touch. So I think that I got a pretty good probability of coming up and testing my 150 strike there. Also, I'm pretty bullish in EA Sports. I don't know if I did show a chart earlier. It's very bullish. You know, like they always say, there's a bear market everywhere all the time. Well, there's a bull market somewhere all the time as well. And EA Sports is in a bull market still. So let's look at this as how these options kind of offset. I'm going to buy the call because I want the directional positive move. I'm going to buy this call and I'm going to sell this put. All right. So remember our basic math, a positive plus a negative equals a negative, right? A negative plus a negative equals a positive. So keep those whole things in mind here. So when we're looking at the options, nothing happens. But if I buy this call, this delta is positive for me, right? Meaning I move higher by $1. That delta goes into my premiums. That's good. All right. I sold a put, meaning I sold these for a high premium or for that premium. And you sell a put, a negative plus a negative makes it a positive, right? So if this underlying moves higher by $1, this becomes a positive to my position. Why? Because it goes down, right? If the underlying moves higher, I sold a put, that negative becomes a positive to my position. All right. And if I sell a put, the negative theta helps me, right? Because I sold that put. Theta every day steals 4 cents from me. On the flip side, I bought a negative theta. That hurts me, right? So they're offsetting. One helps me by 4 cents. The other one hurts me by 3 cents. I'm not worried about that 1 penny today, all right? Then on the other side of it here, Vega is a positive on the calls. Why? I bought it. I want that to go higher, right? Then on the side with the puts, I sold a put. It's a negative Vega. So Vega would be a negative to my position, meaning if Vega increases, that would hurt me. Vega goes down, that helps that side of the put, but it would hurt me on the calls. And you can see that they are going to pretty much offset, sorry, Vega, right? Theta offsetting pretty much, right? Gamma and delta are basically going to be both be positive to my position, right? Because delta is going to help me on the puts if I'm right, and so is the delta on the calls, right? Does that make sense for everybody so far? And then remember, gamma just goes with delta on the second dollar, right? Gamma goes with delta on the second dollar. So when we build this out, one thing I want you guys to all do with this strategy is build it out for a credit. One thing you can do, somebody was asking on the last video, if you want to define the risk on this strategy because maybe you're in an IRA or something, just go out and buy the first. I usually go out and just buy an option, a put for a nickel. And that is not limiting my risk whatsoever. It will limit it a little bit in my IRA because I don't have to put up the full amount of money. But in regards to the risk I'm willing to take on the strategy, that nickel option is not what I'm leaning on for my out. It's just to get around the red tape. But if you wanted to limit your risk on the downside for that, I would probably go down to like a 5 delta or something like that. Try and limit that risk. Just know that it makes it harder on you because the credit's going to be much less. All right. So do it for a credit, because if you do it for a credit, then your break even is down here on the put side. Your strike on the put side is your break even. So you get that 115 put is my break even minus the $1.65. To the downside, my break even is 1.1345. So that's my break even. Anytime you get a credit, you get the break even. Now, if I did this for a debit, meaning I paid something, then my break even ends up being up here at the calls. If you do it for a debit, your break even jumps to the calls immediately. And you have to add that debit to the 150. So it's 150 plus your debit. So it's even higher. All right. So the credit is key. If you're building out a bullish risk reversal, which is what we're doing here. All right. Bullish risk reversal, meaning it's a bullish trade, long risk reversal. And then we can see that this is our chart. We can see we start out right around in here, or our analyze tab, I should say. And then we can see that our break even is right down there where I was talking about, right? It's down on the put side. This is where our negative puts are at the 115 level minus that $1.65. All right. And if you did this as a debit, if this ended up being a debit, let's just say we did this as a debit, then all of a sudden this line would go to here and go like that, right? So you would be trading here. You would have to get all the way to there to get your break even. What would you rather have? Right, break even. All right. So build this strategy out for a credit, because that gets your break even to the downside. You don't have to push that rock up the hill in order to get to profitability. All right. All right. So let's review a little bit. The volatility, I don't know why I went to this one. The volatility on this is what we want to talk about, because we have offset it. We're good to go. So a little bit of review here. The delta on this trade, we were able to offset, right? Because we bought the call. We're buying this option. So all of these are normal. Buy plus a buy, or buy plus a positive is a good to our position. Now, and this is the assumption, we're moving higher, right, folks? We're advancing. So we're assuming we're going to 129.97, $1 higher. So if we move that dollar higher, which as a matter of fact, I think that's what happened today. We did move just $1 higher. And this position is trading right around 108 right now. So we could probably figure out what would happen. 50 cents, right? 50 cents higher into my position by moving $1 higher today, right? See if I can do this without making everybody, oh, I don't have it. Let's just pull it up over here. I'll pull this platform over here, because we can go, and those were the 115s, which the 115s and the 150s, I think they were, right? I'll have to double check. What were they? The 115s and the 150s. And EA just got the new option months. I probably would have picked those, but so the 150s, looking to buy those, sell the 115s. I don't know why that didn't work out. Why isn't this? I held down the, there we go. Come on. There we go. $1.02 now. So we are actually closer to $2 higher from the previous day, right? No, $1. So almost exactly $1, right? 129 to 130. So we move higher by just over $1. We can check to see what happened to the other points on this, but $1 move higher, 25 cents there, 25 cents here. That's your 50 cents coming into this premium. That puts us very close to where we were before. A couple of pennies here and there based on the market movement. We probably got maybe some volatility coming out here. Let's see, we went from 30 to 38. Volatility came into it. Oh, 38. Didn't really move very much, maybe down a little. So most of it's going to be due to just the movement in that underlying, maybe 1 or 2 pennies here to throw it off with that Vega and the Theta that we had off by a penny here and there. But for the most part, you can see that when we make that dollar move higher, we got 50 cents into our premium or taken out of this premium, which is good, right? We've sold high. We want to buy it back for debit, if you will. All right. So higher this goes, that could happen. And that will work out quite nicely for you. That's all I got, guys. If you don't have any more questions, please, I will circle back around. Don't hesitate to reach out and questions, even if you're watching this a day or two later or a year later. I do find out. They hit me up, say somebody got a question for you. So I will reach back around and find out. But don't forget to smash that like button for me, folks. I know a lot of you guys stuck around for a while. I bet you guys have something you can take away from it. If you do, please hit that like button on Facebook or in YouTube. I know YouTube has a little bit more rules or whatever, but we're doing this on Facebook as well. So the thumbs up feeds the bots to run out and find somebody like you to share this content with. So please do that, because for you guys that are watching this, I'll throw this over there in the chat window so you guys can take advantage of this. This is basically all of our content for the most part of all the strategies there. 15 hours of content, rising interest rates. Think we're in that kind of environment. How to take advantage of rising interest rates, how you can hedge that in your portfolio, folks. Your portfolio is based on the price of the bond. And as interest rates go up, bond prices are going down. So that's going to hurt your position or your portfolio value. So, and how to streamline your process, finding when, where, and why we implement those strategies. That's all I got, folks. Links in the window. If you can't take that, take it easy. Oh, one more thing. This is the content you're going to be able to get. This is a snapshot of it. You can check it off as you go along. And that didn't work out. That's all in the darker color. Thank you guys all. I do appreciate you. If you can't take that, take it easy. Bye for now.